So let me ask you this. How do you measure the financial health of your business? Most business owners, especially when they're just starting out, tend to look at just the cash balance, for example. And you might check your bank account balance and think, hey, I've got more than I thought I did. Or, oh boy, I didn't know I had that little left in my bank account. And that can affect your mood and then the decisions that go along with that. If you're coming from a place of scarcity in your business, thinking you don't have enough money, you could be missing out on opportunities to invest. Similarly, if you think you have plenty to spend, you might be a little bit more frivolous or a little more impulsive with your spending. So let's say you look at your bank account in your business and it has $100,000 in it. What's your reaction? How would you feel? Now, using that one number, if you see there's $100,000 in the bank account, that using that as a basis to measure your overall financial health or having that direct the mood that you operate from in your business is just like giving power to that one number on the scale and letting your entire mood and the judgment of your entire health rest on that number. Using a bank account balance to measure the financial health of a business is like measuring your overall health from your weight. It is a snapshot metric and it is temporary. And it's really not fair for you to judge yourself on that one metric, nor your business. And that's why I wanted to walk through today four financial metrics that you should be using to track your overall financial health. And here's the other thing. None of these four metrics work in isolation. Looking at any single metric is one dimension of the story. And that is so crucial for business owners to understand because all too often we see this one metric on social media. We see one type of number and we hold ourselves to a standard to reach a certain amount of money in sales or revenue, which is our first metric. And revenue is vanity. Revenue is vanity. Revenue is the most inflated number of all of them. And it is where the story begins, but not where it ends. So, your revenue, let's talk about that. Revenue is also called sales, it's also called gross income, and it measures how much is coming into the business from your customers. And most often, when you see folks boasting on social media, you see these Instagram profiles that say, seven figure CEO, multiple seven figure business owner, multiple six figure, da 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 da. Da. What they're talking about is revenue. What they're talking about is the top line, we call it, of the balance, of the profit and loss statement, the top line of the profit and loss statement. And the most important thing to look for when you're looking at your revenue number is consistency. Here's the other thing you have to know about this vanity metric. If somebody hit it once in their entire business, they've been in business for 5, 10, 15, 20 years, and they say seven figure business owner, they're not wrong if they have once touched seven figures. However, it does give a misconception that they run a consistent $1 million+ enterprise on the top line. And that may not be the case. And it's really important to understand, well, how long ago did you hit that seven figures? And have you been able to sustain it? Right? I want to normalize normalize boasting about, more than just revenue on our Instagram bios, more than just the sales numbers, because we are only showing part of the surface level when we look at that. So if you're ever looking at these Instagram bios, if you're ever looking online and you're thinking, gosh, all these people making six, seven figures, why not me? Or wow, that's so unreachable for me. Believe it or not, most of them are not sustaining it. Most of them do not keep most of that money. Most of them do not. And you're not alone. And that's the whole thing. They're putting up some type of persona. They're also branding themselves to be an expert in an industry. And you have to be careful about that because that is to call in a certain type of person from a marketing standpoint. That is not the full picture of their financial health. So let's talk about how you can figure out your revenue, understand your revenue, and maximize it. Now, a pro tip when calculating your revenue is to create what I call income centers when you're tracking your income for your business. So let's say you have multiple different offers. Let's say you have one on one coaching, maybe a course that you sell online, and then maybe some type of group program, right? So if you have a one on one offer, a group offer, and let's say a do it yourself online course. Now, each of those could have their own income accounts in your bookkeeping, and you can keep track of how much you're actually earning from each income source. So, even though it's simple enough just to track income overall and track your revenue, you can split this up into different offers, into different categories. And this will tell you a lot about which offers are performing well, which ones are the most profitable, which ones are the most lucrative. And it can help you pinpoint a warning sign really early on if something's not doing so well or it's not trending upward. If your sales are going down over time, it's great to be able to treat what could be causing that. So keep up looking at revenue. Don't dismiss revenue just because of what I've said about the vanity of it. You definitely want to be using revenue as a indicator of your goal. However, I would not hang on that one number, and I'll tell you why when we look at the full picture. So, beyond revenue, let's talk about profit. Now, profit is my second metric, but I'm splitting it up into two different types of profit, which are all included in number two. There are actually two ways to measure profitability. One is called your gross profit, and one is called your net profit. Now, we don't talk a lot about gross profit in the service industry because what you do is you take your total revenue, you subtract what's called cost of goods sold or cost of sales, and you get gross profit. Now, cost of goods sold are not your general types of expenses. This is what cost of goods sold is. These are the costs that it takes to make the product you're selling or to deliver your offer. And for a product based business, this is super simple. This is your cost of materials, labor, and shipping, things that will go into your actual product. Now, if you're an online service based business, like let's say you're an online coach, let's say you're an accountant like me, right? We have cost of goods sold, but it comes in a little bit of a different form. The cost of goods sold would be for a coach, let's say it might be your course platform, it might be your membership system, it might be software and apps that are essential for you to deliver your product or service. And for me, for example, let's look at me as an accountant. I would have as my cost of goods, if I have tax return income because I prepare tax returns, one of my cost of sales is the software that I need to prepare the tax return, right? So similarly with accounting services, one of my cost of sales is the bookkeepers that I hire. It's the QuickBooks software. It's the, other tools that I need in order to do that service. So if you're monetizing a podcast, for instance, then this microphone would be considered cost of sales for that particular income channel. So you want to look at what are the essential or mandatory costs. Think about mandatory costs where if you no longer paid that bill, your offer's lights would go off. Like your offer would be no more because you can't do it anymore. Like me and my tax return software, I'm not doing tax returns by hand. I need that software to do it. Otherwise, I wouldn't offer the service. So think about your version of that. That's probably your cost of sales. So revenue minus cost of sales or cost of goods sold equals your gross profit. What does gross profit tell you? Gross profit tells you that your offer is profitable at its core. So without any discretionary spending only what you need to make the offer happen. Is it making you money? So for example, my tax returns, let's use as an example. If my tax return software costs more than I'm charging to do all my tax returns, then what's the point, right? Make sure you're making money from the get-go and that you're covering all of the essential and mandatory costs. So this is telling you, gross profit will tell you how good are your prices. So look at gross profit to tell you how good your pricing is and how profitable you are at your core. So forget all the other discretionary spending that you're doing, right? This is at your core. Is your offer profitable? The second type of profit, which you're probably more familiar with, is net profit. And net profit is after all of the operating expenses come out of the sales. So you've got, recapping, revenue minus cost of sales is gross profit. Then you take that minus all your operating expenses and you get net profit. And net profit is what is left to essentially pay yourself or to distribute. Now, net profit would include or reflect all these operating expenses. What are operating expenses? These are advertising, marketing, coaches, consultants, accountants, lawyers, contractors, all the other services that you pay for. This could be apps and software. This could be office expenses. This could be rent. This could be utilities or Wi-Fi for your office. This could be vehicle expenses. All of these are considered operating expenses. So these are the costs to run a business. These are the costs to have a business, regardless of the offer. So we look at the overall picture. This is an entire profit and loss statement, by the way. We just walked through the entire profit and loss statement. And what you have to look at is how much is really being caught in the profit and really being kept by the owner. This is why we call this podcast Keep What You Earn. We want you to keep as much of that as possible. We want that profit to be as high as possible. And we want you to be able to keep more of the money that you're making. Now, when we're looking at the income statement or profit and loss statement, we're looking at revenue, profitability, we're looking at performance. Think of these metrics as performance metrics. These are the things that will tell you how well you're doing on a very surface level. Are we making money? Yes or no, right? Are we doing well this year in terms of sales, in terms of controlling our expenses? This will also tell you how you should be triaging or treating issues that you're seeing. So if your profitability is going down, what's going on? Are costs going up? Are your sales going down? How can you identify possible warning signs before they become a bigger problem? So this is why two of the metrics that are the biggest for you to look at are revenue and profit. Now, let's talk about the last two. And before I get into the next two that are not on the profit and loss statement, I do want to point out one more thing about profit. Your net profit is not the same thing as cash in the bank. So let's say you made $100,000 in revenue. And let's say you kept $25,000 in profit. That means that you've spent $75,000, right? And if you started in your bank account, let's say you just started with zero to call it even, then wait a second, wouldn't we definitely have 25,000 in the bank account? So if I made 100, spent 75 and I had a $25,000 profit, that means that there's $25,000 in the bank, right? No, not necessarily, because you can take money out of the business. You can put money into the business. So you can do all of that without it showing up in that profit calculation, which it shouldn't, by the way. These are not income and expenses. These are, just putting cash in and out of the business. So technically you could be overdrawing. You could be having $5,000 in your bank account, not 25. So the cash in the bank is just a glimpse. And the cash in the bank shows how much you've pulled out of the business or put into the business apart from the results of its performance. So this is number 3, is cash in the bank. And I don't encourage business owners, as I mentioned in the beginning of the episode, I don't encourage business owners to solely look at their cash balance to measure financial health. But I do believe that cash is a great indicator of progress, of where you stand, and of a snapshot. Now, having cash means you have purchasing power. It means that you have the ability to adapt. You have stamina as a business owner because you have control over that money. It's in your hands. You have custody of that money. And look what happened in 2020. Cash was everything. Cash was so important that the government created a program called the Paycheck Protection Program that was designed to help business owners cover their payroll who didn't have enough cash on hand to do so in reserve. So having a cash reserve really made or break businesses in 2020. And it really made a difference in whether or not they were able to survive the pandemic. And I think we all learned a lesson as business owners during that when we were given the advice to have a, 3 to 6 month emergency fund handy, we needed it. That was the rainy day and we needed a rainy day fund. And I think that it was a stark reminder for all of us as business owners to be more disciplined about keeping that. So I recommend highly to have a cash reserve in your business to cover expenses as they come up, so that if for any reason your doors are closed or you're limited in your ability to earn revenue, that you're able to cover your expenses to keep the lights on. So cash, again, crucial, crucial metric in establishing financial stability and your stamina as a business owner. Can you continue on in your reserves if something happens to your business? Now, looking at cash trends can be really helpful. So if your cash is going down during the year, even though your profits are up or remain steady, what does that tell you? If profits are steady and positive, but your cash is going down, what's happening? Well, as an accountant, I would look and see, well, how much are you pulling out for personal expenses? Because if you're pulling out a lot out of the business, that makes the cash go down, but it doesn't drop the profit. So I look at trends like this as your CFO to understand what's going on in the business and where we might want to either control a little bit more of the owner's draws. Maybe we need to infuse a bit more cash into the business more periodically, especially if you're first starting out. Or we need to up our sales goals to meet the lifestyle needs that you have as an owner to pull money out. So we always want to be looking at the cash trends to see what is the story that it's telling you. And the cash trends can also show you the footprints of, where has the money gone, and what are you spending it on. Now, there's this thing called cash flow, which I'm not going to get into in this particular episode, and I probably will do an episode. If you want a cash flow episode, text me cash flow to 860-609-6374 and let me know if you want me to go into detail on what cash flow is, because I think it's such a crucial concept for business owners to understand. I will do an entire episode on that if you text me. So now let's talk about the fourth metric that I recommend you look at. So let's recap. Revenue, gross profit, and net profit, cash. What's left? Well, we're going to stick to the balance sheet to find this one. This is where you would find on the balance sheet, you'd find your assets, liabilities, and equity. And the metric that I recommend that you look at is called net assets. And the net assets are what you truly own in your business. Let me explain. So on the balance sheet, which I think is an underappreciated financial statement, by the way, everyone focuses on the profit and loss statement. Let's talk about the balance sheet for a second. If you run your balance sheet out of QuickBooks, you'll learn a ton. And first, you'll see all your bank accounts. You'll see what you own, what belongs to you, your property, your fixed assets like your furniture, your equipment, machinery, cars, vehicles that you own in the business. So you'll see assets. And then you'll also see liabilities, which is what you owe. These are your debts. These are payables. These are bills that are due. These are credit card balances. So this is what you owe. And then if you take assets minus liabilities, you're left with, what do you own after all your debts are paid? What are you left with after all of your debts are paid? And that is our fourth metric, the net assets. So this tells me as your CFO how stable you are, how much of a good footing you have, because you could have $100,000 in the bank, like we talked about. You could have $1 million in the bank. But if you owe 5 million, then you're not so strong. So again, one metric does not drive everything. And the net assets will tell me how solvent you are, which is another word for how well you can pay back your debts. It will tell me really how healthy we are if all of our creditors called. Again, look at 2020. If all of our creditors called and said, "Hey, we need that money paid immediately. Hey, we need you to pay up now. Could we do it?" And if we can't, then we want to be really evaluating, okay, how can we be in a better position to be able to do something like that? And that is a crucial step in evaluating the overall financial health. So now you kind of see why looking at one metric is not enough to tell the whole story. Analyzing the numbers and how they actually relate to one another is where you start identifying patterns and even the warning signs that you can pick up on before they become a problem. And if you're wondering, okay, I kind of get all these things. I understand what you want me to track, Shannon, but where do I do this? How do I even start and begin? How do I track all this? Look into our services in the show notes for CFO services. This is something we help with. Also, you want to start with really solid bookkeeping in order to really analyze all of what there is to offer in these numbers. You really need to know where you stand and have accurate numbers to work with. So, having really good bookkeeping is the foundation. If you're already tracking your books in, let's say, QuickBooks, Zero, FreshBooks, or one of those platforms, or even a spreadsheet, you can take those and run reports and figure out what all these metrics are telling you. And if you need help with that, do feel free to reach out. Again, you can text me. I'm at 860-609-6374. If you have any questions about anything you heard in today's episode, please shoot me a text. And I look forward to answering any of your questions and going into more detail on the metrics that you want to talk about more. All right. Until next time, keep on learning and keep on earning more.